Hi everyone, welcome back to my channel, Your Everyday Economics, and in today's video, I will be telling you how one can change their mindset for long-term investing. There are 5 key points to consider while looking at investing for long-term. While it is possible to make quick profits doing short-term trading, it is not sustainable in the long run. It is subject to market risks, and many times investors do not have enough knowledge and end up making wrong decisions and lose money on their investments. Short-term investment involve more risk. Market fluctuation can cause panic in people, and it does not suit a lot of investors who are looking for growth in their investments. Thus, these short-term gains are not sustainable. Point number 2. Long-term investments give you more stability. Unlike the short-term investment, you get more stability and sustained growth over the long run. By investing for long term, you're able to ride out market fluctuations in the short term and gain over the long period of time. This is done primarily through the power of compounding interest. So when you leave your money somewhere for a long time, it grows exponentially each time period. The longer you leave your money, the better returns you will get. This strategy provides more stability and you are more likely to achieve your financial goals. Let's say you invest $10,000 in stock market index fund that has an average annual return of 8% over a 30-year period. If you keep the money invested for the entire 30 years, your investment would grow to approximately $100,626. That's more than 10 times of your initial investment. Now, let's say you withdraw the money after just 5 years. Your investment would have grown to approximately $14,692. That's still a gain of $4,692, but it's nowhere near the $90,626 gain you would have made if you had stayed invested for the full 30 years. This example shows how the power of compounding can greatly benefit those who invest for the long term. By leaving your money invested for a longer period, you give it more time to grow and take advantage of compounding returns. Now let's change one thing in this example. We will change the annual rate of return from 8% to 10%. Now, how much you will get after 1 year, 5 years, and 30 years? After 1 year, you should be getting $11,000 on your $10,000 investment in a stock market index fund with an annual average rate of return of 10%. After 5 years, it will become $16,105, and which is a total growth of 61.05%. But after 30 years, it is going to be $174,494 approximately. So your investment would grow by an astounding 16,045% to become a total of $174,494. So this clearly shows the power of compounding returns over a long period of time. Point number 3. Patience is the key component for long-term investment. If you want to grow your money, you need to ignore the market trends, whether it's going up and down, and decide to do trading for short-time basis, buying and selling shares. Don't do that. You need to keep your money and leave it for it to grow over time. I have talked about this in my previous video where I showed you a chart which shows the S&P 500 return over the long term, and you saw that it was trending upwards. So it's essential for you to avoid making those impulsive decisions based on the short-term market fluctuations. Another important point to consider is called diversification. Diversification is the key to have a stable long-term portfolio. You need to invest in different asset and sectors so that if one sector or asset class doesn't perform, you don't lose money and you are overall covered. What type of asset class to include in your portfolio depends on your age and risk tolerance, and we will be covering those in detail in future videos. Lastly, I would say you must consider your age, your risk tolerance, and your financial goals before making any type of investment decisions. While short-term investing can provide quick gains in some cases, most of the time when you leave the money for the long run, you are better off. It is more stable and grows because of the power of compound interest. Thus, by following a long-term investing strategy, diversifying your portfolio, and taking the emotions out of your investment, you can grow your money and build wealth over time. So this is it for today's video. I hope you found this information useful. Please give it a thumbs up if you like this and subscribe to my channel, and I'll see you soon in my next video. Bye.